Starting, I would like to extend a very warm welcome to all our participants, esteemed speakers, and dignitaries to the panel discussion on Fintech in India, the road ahead, organized by the IMC's Young Leaders Forum. All participants will be muted during the course of the session. Kindly post all the relevant questions in the chat section along with whom the question is addressed to, so that the same can be addressed during the Q&A session. To initiate this interesting session, may I request Ms. Sheetal Kalro, Deputy Director General, IMC Chamber of Commerce and Industry, to present the welcome address. Over to you, Ms. Kalro.
Thank you. A very good evening to all the distinguished guests present today and my young friends. It gives me immense pleasure to welcome each one of you to this panel discussion on FinTech in India, the road ahead, organized by IMC's Young Leaders Forum. A special welcome to all our young and brilliant panelists. We are grateful to you for sparing your valuable time to help each of us benefit from your in-depth knowledge of the subject. Financial services have seen a tectonic shift, like we were talking just before logging on, across businesses, technology, engagement, regulation, and services. The buzz around FinTech has gained substantial attention of traditional financial institutions, startups, venture capitalists, and regulators. Bank and regulators are hard-pressed to revisit their opening model and policies respectively to create a conducive environment of collaboration amidst the participation of the FinTech ecosystem. The technology infusion is leading to a creative disruption of the status quo. The rate at which evolution of technology is happening, we are more likely to witness a revolutionary adaptation to all things digital sooner than later. The FinTech space has witnessed a massive growth in recent years. The best example is UPI, which has disrupted traditional financial transaction methods. A sustainable financial world is not just for us, it is also for the future generations. You must have noticed from this year's budget that platforms enabling startups are going to get a lot more traction. There is an unprecedented opportunity for young entrepreneurs to cater to the needs of billions of people. These young entrepreneurs are willing to go all out there and seize every opportunity, I believe. India is a fairly underexplored market. There is therefore a chance for a leap in technology and innovation. This has the potential to grow not only in India, but also spread its wings to the global market. Amazing talent base in India, I'm confident that India is well positioned to shape the future course in this area. Let me share a few words about IMC before handing it over to the moderator. IMC Chamber of Commerce and Industry is a premier chamber of commerce in the country with a legacy spanning over 100 years of excellent service to trade, industry, and commerce. Through its various expert committees, IMC provides policy inputs for the government, both central and state, and is continually engaged in activities with policymakers at various levels. We organize interactive dialogues, workshops, conferences, and other activities, and government leaders engage with members on a wide scale. The Chamber is now a cradle for nurturing young talent. It promotes gender equality through Young Leaders Forum and IMC Ladies Wing. And the theme for this year is Partnering for Growth. I now request our esteemed panel of experts to dive deep into the topic, especially to the recent bans of digital lending, mobile gaming apps, how are privacy data and national security issues safeguarded by digital lending applications and FinTech players in India, and give us a direction for the financial industry. A warm welcome to Mr. Apen Alexandra, ED Muthoot Group and member IMC YLF. Mr. Anup Agarwal, CEO, Mintipi, Ms. Pallavi Srivastava, co-founder, ProCat, and Mr. R.N. Nair, CEO, Vayana Network. Over to you, Mr. Alexander.
Before we start the panel, I'll just like to point out that Mr. Samir Somaya has just joined. So can I request him to just say a few words?
Yes,
Yeah,
please.
thank you.
Over to you, Mr. Sumaya.
Sorry, I'm having network problems. So there are some places where fintech needs to still reach with technology there. I often say I live in the old world, but at the same time, I don't recall when I used cash last. I use Bheem, and I've been using Bheem for the last 3 years. And the only reason I carry my wallet is to show my Aadhaar card when I catch a flight. So clearly, the world of fintech is upon us. And I'm very much looking forward to what else it can do for those of us who are in the old world, but were very delighted to leapfrog into where it went take us. So thank you very much. And I'm sorry I'm having some connectivity problems and I couldn't join earlier. Thank you.
Thank you, sir. We are indeed honored. Now, may I request the elite panel for the session who would enlighten us on fintech in India, the road ahead, to join us. I hand it over to Mr. Epan Alexander, Executive Director, Muthoot Group, and a member of the IMC YLF to take over as the moderator of the session. Thank you, sir. Over to you.
All right. Thank you. Thank you, Sheetal. Thank you, Samir. Am I audible?
Yes, sir. Very much.
All right. Perfect. So good afternoon, everyone, and welcome to our panel discussion on fintech lending in India with a special focus on lending to small and medium businesses. My name is Epan Alexander, and I'm honored to be your moderator today. So small and medium businesses, commonly known as SMEs, are an integral part of India. They contribute significantly to the GDP. Roughly about 30% of the nation's GDP, about 48% of the nation's exports, and it employs about 11 million people. It's no wonder that every administration in India focuses on this sector and closely ties the fortunes of this sector with the growth of the country. In fact, a little bit of a trivia, Nirmala Sitharaman, our finance minister, in her recent budget speech, mentioned MSMEs about 20 times in her budget. So the budget includes several boosters for this sector, including about 9,000 crores of credit guarantee, which is expected to help onward lending of another 2 lakh crores of collateral-free credit to MSMEs. SMEs in India are highly diverse, with a vast array of businesses operating across multiple sectors, including manufacturing, services, agriculture. The sector comprises a mix of traditional and modern businesses, ranging from street vendors to small family-owned businesses, to tech startups and high-growth enterprises, and even includes social media and influencers. So this diversity of SMEs present a very unique challenge in terms of underwriting and financing this sector, as each business has its own specific needs and risk profile. SMEs in India have often faced a significant challenge in accessing finance from traditional sources such as banks. This is due to a range of factors, including limited and often patchy financial history, lack of acceptable collateral, and a generally high credit risk associated with these sort of small and medium businesses. In this light, fintech has emerged as an alternative financing source for MSMEs, offering quick, accessible, and affordable financing solutions. And fintech lenders today use technology and data analytics to assess credit worthiness of their borrowers, making it easier for SMEs to secure loans without the need for cumbersome paperwork or a collateral. So the growth of SME funding in India has been spurred, of course, by things like smartphone penetration and internet penetration. The government has also launched things like PM Jan Dhan Yojana, UPI, and many other initiatives under Digital India. So there have also been collaborations between fintech and banks as well as NBFCs to help improve their reach. Of course, fintechs have also been facing some challenges recently. There is a looming sense of regulatory uncertainty. Being in its nascent stages, fintech in India has to navigate a complex and often uncertain regulatory environment. This can be a barrier for growth. Although there have been some recent guidelines by the RBI, many feel that this is just a start of it and there's more yet to come. Another challenge is the access for funding. I mean, fintechs themselves, sometimes, some of them find it difficult to access affordable funding. And many fintechs today find it difficult to secure institutional funding. There is also a lack of credit data. Of course, that is a problem that they were set up to solve. However, it remains a challenge. Access to consistent credit data. However, a lot of progress have been made in this, including a lot of impressive alternative models that they have all developed. Lastly, inherent to the business model dynamics of the fintech sector, customer acquisition and retention is also a challenge. However, with the best of talent coming from across industries being attracted into the sector of fintech, there is no dearth of fintechs who are differentiating themselves and providing real value proposition to their customers. So I'll briefly introduce our panelists, beginning with our lady panelist. Pallavi Srivastava is the co-founder and director of ProCap. She's an alumni of XLRI and has worked with institutions such as the World Bank and IFC. ProCap works towards building inclusive financing technology for MSMEs. The other gentleman on this forum is Mr. Ramaswamy Iyer. He's a graduate of IIM Ahmedabad. He founded the Vayana Network in 2017, which works with SMEs and financial institutions to help finance trade. The third gentleman is Mr. Anup Agrawal, a chartered accountant by qualification. Anup has worked with institutions such as Jefferies and Kotak's Investment Bank. And in 2017, he co-founded Mintify, which is an AI-driven SME lending platform for the B2B segment. So as it's evident to you, our panelists represent some of the most promising fintech lenders in India today. I hope that the discussion today will provide valuable insights and spark meaningful conversations on this very relevant and important topic. So thank you for joining us today. And without further ado, let's begin the discussion. Let me start with a fairly open-ended question to get the discussion going. And perhaps I can start with you, Pallavi. Just to get the discussion going, could you perhaps tell us what inspired you to get into the space of fintech and SME finance?
Thanks a lot, IMC, for doing this, and Epan for having us here. So, coming to this this whole ecosystem has been quite an eye-opening experience for all of us. Specifically speaking about my experience, I had no intent of starting something on the access to finance for SME space. But what led to this is actually, the experience of seeing that there is such a huge credit gap when it comes to the MSME space, right? We look at the global SME market and compare it with India, we host close to 20-25% of the SMEs right here. My work at World and IFC was taking me to markets in India, in South Asia, in Africa, and I saw that the SME problem is common across, right? So that was the genesis of it. And realizing that there is a massive gap and a massive opportunity for us where we can really make a dent. And these are all the MSMEs that we work with are really the entrepreneurs, right? And if we can do anything to shift the orbit for them, the impact that it's going to have on the overall economy seemed like a good enough, worthy enough reason to commit to it and start solving for this space. So that was really the genesis. And what we really do is we work with the trading MSMEs, right? So you have the manufacturing MSMEs and you have the trading MSMEs. The time when we started around 2016, 17, when we were thinking around it, we could see that the manufacturing MSMEs, there's a lot of focus by government, there's a lot of, support available for them. There were also some kind of players coming in and solving for those MSMEs in terms of access to finance, digitization. But when you look at the trading infrastructure where you have your shopkeepers, distributors, wholesaler, retailers, there was a complete white space. Traditional lenders could not lend to them because of all the reasons we know. There's lack of access to data. They don't have collateral to give. Documentation is a challenge. It's a high cost to servicing these kind of small ticket size loans. But there was a very interesting reason that we encountered, which is that there is an informal economy working, which is what we are trying to formalize and digitize, right? So while on one side we are helping these customers access to finance, we are also helping them digitize their infrastructure. We are helping them to digitize the way they transact today by virtue of financing. So that's how we started, and really working with these small MSMEs, retailers, distributors, and their associated principal brands to help them access to essential products, as well as provide them with credit to buy from the inventory from the brands. So that's what we do in a nutshell, but looking forward to the interaction ahead.
Thank you, Pallavi. And I think, like you mentioned, the multiplier effect that financing this set of white space that you've identified is phenomenal, and I'm sure this is what helps you get up every day and get to work, and it's truly inspirational. Anup, probably same question posed to you. What made you move from Jeffries to, let's say, take up this entrepreneurial venture at Mintyfield?
Epan, thank you so much, and good afternoon, everyone at IMC. So Epan, I don't know if you recollect, but when I was in investment bank at 2015, I actually met with your family, and was super impressed with the way the family had built the whole business. And one thing was very clear on that particular day, that I want to build something of my own. Honestly, I had no clue that I'll actually end up doing lending. But 2015, when I was still at Jeffries and was running the whole investment banking practice for Jeffries in India, the choice was clear that either I can retire doing investment banking, or probably I can take a plunge at some point in time and try and build something of my own. So early 2016, finally, after 16 years in investment banking, I decided to call it quits. And unlike Pallavi, who had thought about an opportunity and stuff like that, believe you me, I just took the plunge. I had no clue what we were going to do. We kind of evaluated multiple opportunities, but yes, the space in the whole SME segment is pretty massive. And back in the day, today we all are looking at the market, the way it's grown, the whole B2B supply chain, SME lending has become a very, very big theme. Back in the day, all the VCs, private equity investors were just putting money into what we call as consumer internet businesses, right? So your e-commerce companies, the whole car aggregation companies or payments, they all were very, very focused on trying to do something for the end consumer. Build better products, build more efficiency for their transactions and stuff like that. But unfortunately, the whole B2B market was completely a white space. There was no innovation that was taking place. The corporates who have a massive distribution network, they were all still largely transacting in a similar way. People were either transferring by issuing checks, or there were cash transactions that were taking place. There was a lot of paperwork and so on and so forth. And more importantly, the whole supply chain network of these corporate partners, which is typically corporates dealing with SMEs. So think about a network. Let's, for example, Unilever selling its product to a distribution network, which eventually go to the end retailer, and then people like you and me are buying from the shelf of a retailer. That entire thing from a manufacturer to an end retailer is filled with massive number of SME partners, and these are not even what we think about like a large SMEs. You're talking about micro SMEs here, and this is where unfortunately a lot of these people are struggling today to raise capital to grow their businesses. The brands want to support them to grow their businesses, but unfortunately have only so much of capital to support these SME partners. And that's a space that we found it very interesting, because on one side you have a huge amount of SME lending opportunity to this supply chain, but more importantly, you had a lot of good things going about what we call it from a traditional lender versus a fintech lender, right? Traditional lender, the typical process of going through a lot of subjective underwriting, meeting with their customers, trying to, because of the lack of data being there, trying to do a lot of things, on the ground to underwrite these customers and onboard them. Not only the costs are prohibitively expensive, but more importantly, there's only so much of penetration that you can do of credit when we are talking about inclusivity and we are talking about accessibility of finance being available on a pan-India basis. On the other side, the moment you start talking about ways in which you can unlock the data, and as we go along in this conversation, we're going to talk more about what we mean by that. But the moment you start getting access to data, you start getting reach to an organized supply chain network, you suddenly are able to cater to a lot many SME partners in this country without having to build completely from fresh a new distribution network. That makes it very, very efficient. The cost is lower. Thankfully, the credit costs are much, much lower in this segment. And that's where all the, so to say, small little, data points that back in the day made us believe that there's a big opportunity out there. Yes, of course, we went through our own journey over the last 7 years or 6.5 years now. I think it's a massive opportunity. There is a large number of SMEs, even after 7 years of being in this space, we believe we have not even done a fraction of what really requires to be done. And as we think about from a overall business opportunity perspective, I think it's fairly large segment for any one of us, not just one, two, or probably about 100 plus fintech companies coming together alone may not be able to solve for the opportunity that exists in the sector.
Thanks, Anup. I'm glad that we could be of some inspiration to you, and it's good that you could dive right in and dive to the deep end of the pool. And I always say that sign of a great entrepreneur and a founder is somebody who can navigate ambiguity and sort of pivot when required and be flexible. So that's great. Ram, coming to you, I mean, you are certainly not somebody who's new to the startup space. This is your second venture. I think there are signs of a serial entrepreneur at your end. So could you tell me and the rest of the group what inspired you to think about starting the Vayana network?
Well, I think, just as a warning to my other two co-panelists, I started 29 years ago in the space and I'm still remaining here. So maybe it will not be easy space to get out of them also. It's like a whole California song, right? You can check out anytime you like, you can never leave. I think, I'm neither not a finance guy nor a technologist by training. And I think I came into this whole problem like an engineer. And I think it's always been to be fascinating that you have this tremendous diversity in demographics, right? We hardly have about 700 companies, about $1 billion. When I started, it was much lesser. And then, of course, you have more unicorns now, I think, than companies, about $1 billion valuation. I'm talking about revenue. And then, of course, you have this whole, whatever, I don't know what the number is, 30, 40, 50, 100 million micro mom and pop shop enterprises. So I think you first look at it as an engineer and you say, look, if you want to get credit across to all of these guys, then it's a plumbing problem. So I looked at it as a simple plumbing issue, and I've been at it for 29 years, and I can tell you that it's quite a fascinating rabbit hole to get into. The second, of course, is the whole aspect about, risk management. You really kind of have to think about this. If you really want to kind of get credit across to everybody in a responsible manner, you have to really think about how do you quantify risk, to the people who are lending the money, people who are taking the money, people who are referring to you, people who need the money. I think you really need to look at it from that lens point of view as to how do you manage risk. And I think that was a very interesting quantitative problem I think I liked. And third, of course, is the whole, fascinating issue of cost engineering. It's very interesting that I think Pallavi and Anup talked about, the small end, the retailer, the kirana wala, the paint wala, whoever it is on the street. And today, despite a lot of efforts, I think we still kind of having to pad up his credit cost by a lot of, percentage because of the risk issue. Now, how do you kind of get him the same kind of interest rates that makes sense from his net margin point of view? I mean, the average net margins in most of these small mom and pop shops is about 2 to 5%. So how do you get credit cost less than 1% for him? I think that's an interesting problem to solve. It's a lot of, I think, just appeal to the cost engineering side of me. So I think those are three things that we have been working on. I have obviously started from the banking point of view, trying to figure out how you could kind of make banks kind of manage this whole process. Then started with the low-hanging fruit, which is all the large corporates doing it with their next rung of distribution or suppliers. And I think it's just now a journey that we have started towards getting to the farthest ends. It's almost like describing the blood circulation in the body, right? I mean, you have to kind of get to the remotest ends and you have to try and figure out how to keep the pressure there. So I think that's really been the interesting journey. And I think not yet come close to it. We do about $1 billion a month and we are still at about 0.7% of the demand per month basis. So I think it's a long way to go. And as Anup very rightly said, it's going to take about quite a few fintechs, quite a few banks, quite a few NBFCs like you all, even to kind of come together and make it happen. And even then, I think it'll still be barely a scratch of the surface. I think the demand is far, far more. So I think that's, I can spend another 29 years, I think. And I looked at this as an employment guarantee program for myself. I mean, the problem definition is not going to change for a few years, at least.
Great. No, I mean, 29 years as sounds like it's a fulfilled 29 years that you're getting, and the learning that you're getting is phenomenal. Ram, probably, since you have the most amount of experience under the belt, I can direct the next question to you. You have seen how this space has evolved, for at least the last 10, 15 years. What in your opinion are, let's say, 2 or 3 key game changers that have come in, whether it's in terms of the public rails, the infrastructure that India is providing, or in terms of just pure technology? What do you feel has been a big impetus to this sector?
I think, multiple things. I think obviously the macro factor, I think, of figuring out this whole segment that could be lent to, because, if you traditionally look at it from a lender's perspective, commercial lending, which is really your MSME lending, had all the disadvantages of corporate and the disadvantages of retail. Nobody talked about it having advantages of both. So I think for a banker, commercial banking was not really the job promotion he was looking for. So I think there's been a whole macro change in that, and a lookout change in that people now think commercial banking is probably the real hotspot for everybody. So I think that's been a big change. I think public infrastructure in India, as I keep saying, for fintechs, that's probably the biggest competitor out there in many ways, because I think we have really kind of gone leaps and bounds on the public infrastructure, with NFIR coming in, with I'm sure UPI 2.0 kind of pushing the envelope a little bit further. I think, with this whole SCI, SME single registration, allowing for group lending, I think there are just enough and more, I think infrastructural items coming in addition to all that was built, JAM or DigiLocker. Nirmala Sitaramji introduces DigiLocker concept as a very interesting KYC, repository. So I think you are going to find a lot of those infrastructure anyway, I think, taking us to figuring out where our own relevance. So I think, that's what really, I think, will propel a lot of innovation, because we can't be just satisfied with just providing the basics. I think we'll have to really figure out what is the difference that we are making, because most of the stuff can be done through the public infrastructure. The third, I think, is, technology has kind of gone in. I think India still remains a bit of a phygital market. While we obviously talk about mobile phones reaching out everywhere and, people getting used to apps and all that, I think there is still some way to go there. So I wouldn't say technology, to me, has been a bit of a disappointment, actually. I think it's really been the public infrastructure. It's been a change in the macro. It's been change in a lot of companies and corporates changing their whole distribution and supplier lens. One of the very interesting things, as Anup and Pallavi probably have already, witnessed, is that there's a lot of data compression happening across the supply chain. People at the top, Unilever, as Anup mentioned, wanting to understand what's happening at the retailer end, that automatically means a lot of data is getting, spanning across multiple tiers of the supply chain. So I think all of that is kind of resulting in this sector being, I think, in the limelight. One last pointer, of course, is that, 3 years or 4 years before, as some of my panelists would say, when you have to really explain supply chain finance or trade finance to everybody, right, starting from scratch, and most people would then shake their heads and say, this is just too complicated for us. B2C is much easier. And nowadays, people already have their thesis built in, and already understand what the space is and understand what's going on. So I think that's been a big change, really. I mean, that, raising money has not become easier, but it is at least you don't have to start from basic foundational principles. What is supply, what is chain, what is financing and stuff like that. You can assume a certain level of knowledge. So I think that's been the big change for fintech startups like us. But I think there is I think in India, the biggest challenge for us is going to be how to be relevant. And I think I would say that's the thing that's going to propel us to a lot of innovation, because I think the bar for innovation is so high that we can be different. I don't know whether we can be better. And I think that's the key for us to kind of figure out as we go along. So that's why I said there's a permanent employment opportunity here for anybody who's listening in and wants to come in. I think there is still lots of space here for innovation here.
Right, right. No, I think I agree with you. I think the mindset change that we have seen, and how, for a lack of a better word, probably supply chain finance has become sexy to sort of talk about. And I'm sure young dynamic entrepreneurs such as yourselves will only have a positive influence and attract better talent to come into the sector.
I wish I could say I was young, Epen. You're probably talking about Anup
relatively. So Pallavi, just coming to you, how do you view the enablement of this sector by, let's say, the government or the regulator, which has also recently sort of stepped in, because generally regulators are a bit behind the curve, especially on latest technologies. So how do you view this enablement of the sector?
So Epen, I think it's a very interesting time that we are in. We are hearing a lot happening with the regulator. You mentioned, during your the introduction of this panel about how we are all looking at regulations as a bit of a challenge at times. But, the view that I'm seeing more and more, the fintechs are taking, and, we were in a session a couple of weeks ago. I think there is a lot more optimism and a lot more, acknowledgement of the fact that this is for good, right? Overall, I think RBI has been looking at, RBI has been very innovative with the regulations, as innovative as we are in our product solutioning. But at the same time, I think there's also this whole encouragement of innovation under the ambit of, what we can understand, right? So the whole discussion today, at least what I'm hearing from all the meetings with RBI or any kind of forums, is how do we define the sector, right? RBI has gone ahead to really set up a fintech department. There's a regulatory sandbox. There's a lot more progressive stuff happening there. As much as fintechs are innovating, there's a lot more focus from the RBI on seeing what's happening, and basis what the understanding that at least I have gathered is that there are two types of focus areas. One is the prudential, where you're looking at the entity itself, right? The fintech entity itself, whether it's on the solvency, on the stability, safety, and the soundness of the company. Then the other side is the code of conduct, right, where you're looking at whether you are having customer protection, whether you are following fair business practices, right? So those are the two separate areas, and accordingly we are seeing a lot more happening on the latter part, where the customer protection becomes the key. Other than that, I think there have been 5 key sort of principles that we are seeing that RBI is following. A is that if it really creates a large scale issue for customers, then perhaps you ban it, right? We saw what happened with PPI recently. If it's too small, then we can ignore it, right? Or if it's if a customer can make an informed decision, then perhaps caution the customers for it. If it's something which is beneficial for a larger consumer set, then passively regulate it. And if it is really helpful for customers, and at the same time there is a lot of they can be data privacy issues, or they can be anything related to customer protection, then actively regulate it. We are, I think, at a stage where we are at the middle stage, where we are seeing that there has been it's too small for us to ignore it kind of a thought process that was happening, because all the fintech innovations have been not seen that kind of scale. But starting last year to, I think, next 2 to 3 years, at least where I see it, there is going to be a lot more active involvement, because the products innovations are seeing some scale. The fintech companies are crossing a certain threshold. So I think there's a lot more exciting stuff coming up, and we need to be ready and prepared. And I think it's just about how we manage our compliances, how we make sure that customers are well informed, how we make sure that customer protection is there, and how we run our own business conduct, doing the right thing. That's going to be very, very important for us as an ecosystem, as a sector, and the responsibility lies on individually on each of us to make sure that we are only supporting in that change. It's a good good change and good sort of enabling environment that the government and RBI has created, and how can we really leverage it to build good quality businesses. And I think I really resonated when Ram said how we can bring down the cost of funds for the customers to really something which is for that's applicable for a lot of large companies, for example. I think that's where the success will come in, where the regulated entities and non-regulated entities, the fintechs, banks, NBFCs, all of us come together and make customer the priority. I think that's going to be for me, the game changer also in terms of how we proceed and see including more and more customers and making that a biggest priority for all of us.
Thanks, Pallavi. I mean, it's amazing how you can say with a straight face that you are excited about regulations. I'm joking, but I fully agree with you that it's definitely a recognition that RBI also wants this space to grow, and I think regulations coming in is certainly good, and I'm happy to see that the players within the industry are also welcoming and embracing it. Anup, just looking at the Mintifi business model, in terms of, let's say, traditional underwriting models followed by, let's say, banks and NBFCs, how has fintechs like yourselves change the outlook towards underwriting? I'm not talking about intervention of technology, but more on your let's say your outlook towards underwriting, or the way that you see the risks associated with this. So I mean, how have you seen that evolve, at least among the fintech players compared to the traditional lenders?
Sure. So I'll break this down into a couple of different segments, keeping all together, right? I mean, I think all the fintech companies started with the first premise with the banks are idiots. We are the smartest people on the street. We understand underwriting better. There's this whole new age digital underwriting, the machine learning, the artificial intelligence. Banks are still doing Excel-based underwriting. They take a lot of time to underwrite a customer. They need a whole host of data points. Unfortunately or fortunately, I think COVID taught everyone, made it a level playing field, that probably what some of the large financial institutions are doing is probably not a bad thing to do. There is an underlying risk, and you need to ensure that you're not in the whole pace of growth in the world where we're all chasing valuation, we're all chasing better investor quality in our cap tables, all of those things set aside. But fundamentally, how you're underwriting the customers, what banks were doing in the past, was it something completely wrong? What we are doing is something much more efficient. And that, to my mind, is an important debate to have, right? I mean, what we need to think about is split this into to say that how do we build process efficiency and how do we leverage data that is available in today's world? What I mean by that is government itself has done a lot of work in building what we call as a public rails, or called the infrastructure around how you can extract data, be it the account aggregator model, the GST, the ITED. Is enough and more information today available, which for whatever reasons in the past the data was not available. To the extent the data was available, people were still using a lot of Excel and pen and paper to kind of underwrite these customers, led to a lot of inefficiencies in the process. People were underreporting the information, and therefore there was also a lot of subjective underwriting. Can fintech companies take the credit of building that whole infrastructure? Answer is clearly no. I think there is a lot of data that is available today, and that's available for everyone. That's just not available to us. That is available to the whole ecosystem. Thanks to the work that government has done. What certainly we think that as an new age tech companies, because we are building a lot of infrastructure from grounds up. We don't have legacy systems. We are not have the baggage of having to straddle across multiple products. You're building a very vertical focused, so to say, organizations. So you're also able to build it in a slightly different way, which means that how do you ensure that if you have different data points being available in the ecosystem, how do you go about understanding those data points, and how do you bring down the overall cost of operations without compromising on the underlying credit risk. I think what is very, very important is, which a lot of people end up doing it, is to say that, okay, because I want to be the fastest lender, because I want to have a turnaround time of 2 minutes versus 2 hours versus 2 days, a lot of credit risk gets compromised. So far, you're not kind of underestimating the underlying credit risk of the customer profile and ensuring that you are doing data mining, but you're not undermining the data. I think it's very, very important, right? You're not kind of you can actually look at somebody's just bureau and give him a 10 lakh rupee loan versus traditional banks who are looking at the bureau, banking, GST, ITR, and then giving the loan to the customer. There is a reason for doing that, right? So I think what the new age fintech companies are able to do it, a lot of these processes which banks, even today for that matter, with due respect, even today, because their systems are built that we are doing a lot of these manually, we are trying to automate a lot of these systems to ensure that a lot of processes that are being done manually don't have to get done, number one. A lot of checks and balances don't have to happen manually, right? Today, like for example, fraud checks, people call the FCU, fraud check units in the banks and larger organizations. Thanks to digitization, thanks to data being available, you can try and minimize a lot of things that exist in the market. The other thing that you can do is, how do you build your funnel, which is a direct sourcing funnel, which I think is a very, very important aspect of the entire lending model. The moment you do not have an intermediary who's sourcing a customer for you, versus a scenario when you're going directly to the customers, a lot of friction that exists in terms of customer onboarding or the quality of the data that is being available is very, very different. I think banks again are still largely relying on the traditional format of sourcing the customers, and not necessarily when you say traditional format is a DSA agents, it could also be paying Google taxes for that matter, acquiring customers through Facebook and Google and so on and so forth. Effectively, the channel still remains where you're being dependent on third party versus going to these customers directly. Of course, banks have their own set of challenges. They are fairly large. They have a branch-led network, a lot of legacy systems, which are they changing it? Absolutely, yes. If any of the fintech companies think that we are the smartest lot and they are not kind of working on that, I think they are also shifting from their approach to adopting a lot of these new age technologies. But having said that, I think to sum it up, I think what most fintech companies, including what Mentify is trying to do, EPIN, is to make systems more and more efficient, to ensure that right from the way you're underwriting, the way you're building your early warning systems, to the way you're doing fraud checks, all of those things, rather than being dependent on either human beings or being dependent on Excel sheets, can you try and automate a lot of these functions? But you're not so to say, hey, I can actually look at somebody's Facebook data and underwrite and give loan to that guy. You're still going behind real data and therefore underwriting these customers better. And thankfully today, given the effort that the government of India has put in, there is enough and more data that is available. How do you extract that data, retrieve the data? That again is very, very important, right? A lot of times when you have legacy systems and you have data which you cannot retrieve and therefore analyze it for your future portfolio performance, you're not able to make use of that data over a long period of time. So I think storing the data is very important, using the data for real-time underwriting and ensuring that you're also able to build systems around risk, portfolio management, and you're building it completely grounds up. Hopefully you have some more efficiency as compared to what banks have been able to do so far.
Right, Anup. I think it's a great point that you make. With the sort of access to the unit level data that you can get for all of these businesses, to get a complete view into their cash flows, understand their unit economics at a much more granular level, definitely gives you a very different. You can view underwriting from a very different prism, and I think certainly I see a lot of fintechs, taking that view. Of course, also fully taking advantage of all the public rails and retrieving data from there as well. I don't know, So Ram, Anup made this point that banks are, we shouldn't certainly write off the banks and think that they are going to be slow and rigid around these things. How do you view, the space evolving between fintechs and banks and NBFCs, especially given the new digital lending guidelines on LSPs and regulated entities? Do you see this as a collaborative approach, or do you see the banks sort of coming up the learning curve and eating your lunch, maybe a few years down the line? How do you see this? You're on mute. Oh, I'm sorry. Is the admin? Yeah.
Yeah, no, got it.
Yeah.
I think Anita decided that,
You're talking too much.
Yeah, exactly. No, I think, look, I mean, I think Anup's point is that, and I think everybody who's been in the industry for long recognizes that Indian banks are very different from, the Western banks. I mean, we have all been kind of fed on the US model where banks take an awful lot of time. There's just too much inefficiency in the process. I think Indian banks are far more agile, nimble, and I think they are probably more deserving of the title fintechs. We probably are a lot more tech fins, I would guess, or only tech, I don't know. But, I think there is a definitely, I think a lot of the private sector banks and now a lot of SBI definitely, I think are all worthy of the title of being really super fintechs, right? And they seem to have the same ambition like most of us and probably have the ability to execute on it. I think the important thing for all of us to recognize is that for us, for the industry, credit is not a moat. There is nothing in credit that any of us can bring in, which a bank cannot bring in, far more cheaper, far more better, far more, with far more NIM, right? I mean, we don't have our own balance sheet to the same levels of gearing or to the same level of cost like a bank does. And as long as you recognize that, then I think you suddenly realize that your work is actually around credit, not on credit. So I think you have to be very careful about how to frame this. I mean, I think world over, people look at banks as the capital source, NBFCs as the distribution source, and startups like the technology guys and the innovation guys, right? I think in India, banks probably take on all the three roles. I think the NBFCs are the ones who probably have to kind of figure out a very, very differentiated path. And you will find a lot of NBFCs now being very niche NBFCs. But I think for technology guys like us, I think we have to figure out what is that we can play a role around credit. And I think, more and more what we look at the whole business as is credit logistics. We don't look at the business as credit. We look at it as logistics. We look at it as infrastructure for the logistics. So, just like physical logistics guys have to figure out how to get from point A to point B, figure out documentation, figure out, how to kind of predict trade. I think you have to do all of that even in the credit side. So I think, a lot of the work that I think startups like us and others on this panel will probably end up doing is to be a lot more focused on why does credit even come into being. So for example, a lot of my work or company's work really is focused around cash management because it's only the gap in the working capital that credit addresses. The question is, what should that gap be? Can we get these corporates and smaller enterprises to manage cash better? Anup raised a lot of very interesting points on credit, including the fact that, banks already, I think, have a lot of figured out in terms of what credit should be. But I think the key thing for me, at least on the credit side, has been that how do you place it in the context of a supply chain, which is what I think all the three of us who are on this panel do. But I think the other real key thing is from a cost engineering perspective, how do you kind of reduce this whole cost of not getting repaid back on time? And I think that's a key factor. While we do a lot of work on the underwriting side in terms of understanding intent to pay and capability to pay and all of that stuff, I think continuous business monitoring is what really I think we will require to do. I mean, we have to understand that for this 30 million small businesses, we all effectively need to have an ECG machine strapped to each of the business continuously. It is like putting on an Apple Watch and getting immediately alerts on blood, pressure rates or heartbeat rates or whatever it is. We will need a lot more work to be done on the monitoring side than on the underwriting side. And we can't do that unless we are very closely involved with the business. So I think a lot of the challenge and the opportunity and the innovation, I think for startups like us, is to figure out how can we be relevant to a small business in running the business, as opposed to just being there for the credit side. I think unless we are there, I don't know whether we really have a relevance, over the next 4 or 5 years in terms of pure credit. I think, we will be, I think while we may not like that word, we will end up being DSAs to banks because we will kind of identify who are the very good borrowers. We will open that up because obviously of all the reporting, they will know that who are the good borrowers and they can sweep in with a 4% smaller credit cost than all of us or a 5% credit cost smaller than all of us. So I think the key question really for us is that can we help all these small businesses who are not credit ready today? And I will love to talk about it, because I think that's a big, at least for us, a big problem statement for us, is that a lot of the real small businesses that I see today don't even bother reading a document that they sign on, right? They have no understanding of what the obligation of credit is. They basically look at the rate and they figure out whether they should take it or not, but they have no idea of the penal rate. They don't have an idea of what all can do to the CIBIL score. And especially I'm talking as you go interland, because all of us have done the low hanging fruit. As you go interland, you start really having to figure this out. I think there's a lot of education required. So unless you can be in that business of helping them in their business, then you can be of relevance on the credit side, which basically means that you have kind of helped them to kind of get to a credit as a very responsible borrower. I think that's really the role I would think for the next 4 or 5 years. People like us have a role to play and of being of relevance. The rest of it, I think, is really we are just playing a holding role till the banks kind of come in and swoop in. I don't see any moat around pure technology or credit, honestly speaking. But my cynicism also could be I spent 29 years on it, so probably you should pardon me for that also.
No, absolutely, Ram. I mean, interesting points that you made, and like you were saying, sometimes it's not as glamorous, but getting the plumbing and logistics, bringing in efficiencies there itself, has huge multiplier effects. And I mean, there are some great business models of people just getting the logistics right. Guys like Visa and MasterCard are actually solving that probably 20, 30 years back, and see where they are today. Pallavi, this is certainly a question that I want to pose to all three of you, because I'm sure it's affected each one of you as well as all of us. COVID was a very, let me put it this way, an interesting period for every lender, as well as anybody who is in the MSME space. COVID and the associated lockdowns, how has it affected, your business model? How have you built resilience among your customers or even within your business models after that?
So Epan, I think 50% of our lifespan or the vintage of the company has been in COVID. So we have all struggled. I think one of the things that we learned coming out of COVID, we just started scaling up when the first COVID cycle hit. So it's been in some ways, of course, not good for anyone, but it's been some way also given us a huge push after we came out of it, right? But in terms of the learnings, I think one of the big learnings that we had was that everything that you can put in document, please do, because we may think that these situations will never arise. All our controls that we thought are very sort of light touch and may never be exercised, everything got tested. We exercised all the controls that we put on paper. So we realized that, legal paperwork documentation is very important. The other thing, I think one big learning, which is very personal to me, has been that, the customers are inherently good people. They are credit worthy. They have an intent to pay. They want to do business in the right way. They want to grow, right? So these are the customers we've been excluding. And I think that just kind of, opened up our minds and also opened up this whole space to see that how we can better our underwriting. And I completely agree with Anoop's point, which he mentioned earlier, that we feel that we are the smarter lot. We have a better data driven, cash flow based, PST data based underwriting models with artificial intelligence, machine learning. But I think all of that in the end boiled down to really understanding the customer's credit worthiness in the context of intent and ability to pay, right? Technology, data, all of that can only help as much, but really getting to the nerve of the customer to see whether this customer will pay us. How do we really catch hold of any kind of errant behavior as quickly as possible? To Ram's point, the ECG machine and real-time data point coming in. I think some of those controls we started thinking through a lot more deeply. We are still nowhere close, but we are constantly, at least on that direction, that all the first principles of doing business make sense. I think that's what has been the key learning. The other part of it is also beyond technology. I think it's about since we do supply chain finance, it's a very relationship driven business, right? So being on the ground, even though you have the best of the abilities to underwrite, the best of the abilities to monitor and control, and still nothing beats just being, having the touch and feel of the market and being close to customers. So a large part of it is driven by how do we educate, right, the customers properly, how do we make sure that there is no mis-selling happening. So some of these things which are beyond tech, on relationship building, being close to the customer, understanding closely on what is it that works, what doesn't work, has been very helpful. That's been the key to building, future proofing and building resilience as we go along. Are we there today? I don't think so. There's a long way to go, especially if we want to go beyond the creamy layer, right? So we have all, as fintechs, defined certain segments. Within that, we're looking at the topmost creamy layer of customers. We're not really going deeper and deeper, right? If we want to go deeper and make the real financial inclusion happen, then it requires a lot more effort, lot more thought process on how do we really include and not get into data driven silos. How do we not get into technology based silos? Some customers are not very tech savvy, so how do we really get to include them when we talk about financial inclusion? So there's been learning, and it's a constant learning and evolution. The sector is also going through a lot more changes, but yeah, I think COVID has been a big learning experience for all of us, by all means.
Great. Thank you, Pallavi.
We have lost your audio, Mr. Alexander. Hello, Mr. Alexander. One second. No. You have muted yourselves. Hello, we're not able to hear you, sir. No, your audio is not.
Hello, can you hear me now?
Yeah. Thank you.
Yeah, hi. So I just wanted to check in with you on something. So I wanted to make a reservation at the Charleston Palace Hotel. Hello?
I think we are hearing somebody else, maybe.
Yeah. Hello.
Somebody has called Make My Trip, I guess.
Yeah, but I'm not finding anybody over here.
Yeah, no, Pallavi, maybe they require supply chain finance. Yeah. Let's pitch it quickly.
Yeah.
Totally. Who's taking the customer first?
Yeah.
I think there was some
There was some
connectivity issue.
I suppose. We have lost Mr. Epen also, so I'll just check whether he's there.
He has just logged in.
Yeah. Yes. I'll just. Yes, sir. Mr. Alexander?
Yeah, go ahead.
Okay, we can hear you.
Yeah, what is the...
Yeah.
Hello, there is some disturbance from your end.
Sorry. Yeah. My bad. I think I got disconnected.
Okay.
Yeah, sorry. Pallavi, as I was saying, it's good to see that we've been able to sort of understand the genuineness of the customer and the intent of the customer, and I think COVID has definitely been a good testing model for all of these businesses. Anup, just coming to you, what were your biggest, let's say, learning coming out of COVID?
Sure. So even I think one is clearly we underestimated the pace at which technology has been shaping our lives. A lot of time when we reach out to any customers, and it's also the case about the sales guys are trying to push their agenda on wanting to get things done and do things irrespective of whether it can be done through technology or not. But the whole idea is how quickly you can get things done, right? And that whole process you try and sometimes not guide customer or say educate customers to go through the whole digitized journey. And to my mind, I think one of the biggest thing that is not just to Mintify for that matter and to this particular panel, I think across the board in this country, I think one of the biggest thing that has happened post-COVID is the digital adoption. Earlier, if you had to do a video KYC, for example, a lot of these customers would not be comfortable in doing video KYC because there was always this reluctance, oh, somebody at the other side will actually take away their data and they will never show up, right? Now, I think people have become far more comfortable across the board, be it in terms of DigiLocker, you talking about UPI, the whole ecosystem, the way it has evolved, I think is phenomenal. And one of the biggest learning has been that for all of us, we need to continuously keep innovating, not think about the fact that, hey, customer is not educated enough and customer will find it hard to adopt it. I think if there is a need from the customer side, and if you're able to, educate him well, I think slowly and steadily, the whole adoption will certainly come. What we have seen with payments in this country. So think about it like being split into on an SME, so to say, ecosystem. It's been split into three different aspects. You've got the whole payments ecosystem, which government has done a phenomenal job on the UPI side. We're talking about $1.8 trillion worth of transactions happening on UPI, right? About 400 million people are today transacting on UPI. So in just about less than 5 years. So there's certainly a lot of adoption that has taken place on payments. When we are talking about lending, and then the third piece that we're talking about commerce. Government has done a phenomenal job in terms of building a lot of those, public infrastructure on the data side, and it is now up to banks and fintech companies to ensure that we are able to, drive that whole adoption of technology from the SME perspective and get them to become more efficient for their businesses, and at the same time get access to better, credit by using technology. Another thing, the third thing that is very interesting that we've seen is the whole adoption of technology also on the commerce side. Earlier, there was still a lot of this whole, process around people having to go take orders. There's physical papers being transferred and stuff like that. The whole concept around, ordering through a digital platform, be it ONDC, which is the government is pushing now, or for that matter, the corporates themselves having built a lot of tech layer for them to interact with the SME partners that they work with. There has been a fairly significant adoption of technology there as well. So I think one is clearly the pace at which the technology is moving forward. I think the second thing that Pallavi rightly mentioned, I think typically you don't see these customers intentionally wanting to default. I think a lot of this has been through the whole journey of a lot of these people having lost their livelihood, they're having to relocate to their, native places and stuff like that. And one big learning has been in this entire process is that for an SME lending segment, it's very important for you to find out who their nearest, it can be his friend, it can be his family member, but you need to take one more reference check being done of the SME partners. Banks have traditionally been doing for many, many years. I think COVID taught us, at least it has taught, fintech companies like us for sure, not necessarily the guy is a defaulter, but the guy needs certain time to repay. And in order to avoid people like us, he may actually migrate to his hometown and stuff like that. And therefore, as a lender, you may never be able to find him out. If you have a co-applicant, it will actually help you to trace him down, work with him. You cannot do stupid things, because he's going through a pain as well, right? You cannot do stupid things, force upon him some crazy interest rates, some penal charges, which RBI is now talking about and stuff like that. But work with him to try and get him out of this whole situation. And to my mind, I think most SME partners that we've been working with, they have been more than happy to, bear nominal cost, not some exorbitant rates, nominal cost. And if given a reasonable amount of time, they are more than happy to repay, get back to their bureaus being not impacted. There's been, by the way, another very interesting, there's been a big awareness in the SME segment on what this bureau is all about. If they default, not just their businesses, in fact, in future, when their kids have to go out and take education loan, for example, right, it will be on the back of their parents' bureau profile. And to that extent, they're very, very mindful of not defaulting intentionally. Yes, if there are business situations and they have to go out and default, it's a segment. We think about it from a very large pool of corporate lenders, corporates in this country who have defaulted, and therefore we kind of paint everybody in the same brush. But interestingly, the SME guy is far more cautious about his overall credit profile. and is ready to work with the lender to ensure that he's able to get out of this situation, which is, it's not his fault. It's something that's got everybody impacted. But if you try and push him too much, the first thing that he will do is just disappear from the face of this earth. And then it's become very hard for you to go and trace him and get your money back. So you need to work along with him and ensure that, both he and you become, successful at the end of the day.
Yeah, and I mean, it's a great point that you made on how digital adoption has just, it's been a hockey stick, right? And I think what we have seen in India is sort of these sort of external shocks, whether it be demonetization, whether it be the COVID associated lockdowns, brings, a tectonic shift in the way people are willing to behave. Yeah. And also interesting to know that, even fintechs look at the traditional models of bringing in co-applicants and guarantors. And incidentally, one of the SME lenders, a secured SME lender that I was speaking to recently, said that if it's a very risky profile, he actually asks the father-in-law to stand as an applicant. I mean, who better to stand as a guarantor than your own in-laws? So I think some of these social networks and social fabric still holds true. Ram, same question to you, Ram. I mean, what have been your learnings? I mean, I'm sure in the last 29 years, COVID was definitely something unique to you. I know you've been around, you've seen, been around the neck of the wood, but what were your learnings, and what have you incorporated into the Vayana network?
No, I think, look, I mean, 5 years back, I think the big mantra was cash flow based lending models, right? I mean, everybody talked about that as being the gold standard in terms of figuring out whether these real small businesses could repay back or not. I think that model still exists today and is still relevant. But I think what COVID really kind of taught you is that, how much of stress could the cash flow lending model actually take? And I think as you go down to micro businesses, you will figure out there's not much fat in the system for them to kind of take that shock. So a lot of the cash flow lending models do not really kind of help you to figure out, the old Toyota example where the chairman would change the dollar yen rate drastically just to figure out whether the car sold would still remain the same as per forecast. I think a lot of us have had to go back to our cash flow lending models and apply a lot of very interesting scenarios to it to figure out whether that business will still be able to repay or not, have the ability to repay or not. So I think that's one, I think, more tactical or more important thing that we have all figured out. Second, I think, is that because we all play in this role of supply chains, and if you really really look at the supply chain and use it correctly, you'll find that it has got a tremendous amount of role to play as the guarantor or the collector. And I think one of the things that happened for us, at least during the entire COVID phase, is that our DPD 30 was actually far lower than pre-COVID also. Because, that was a very interesting phenomenon. For the simple reason we figured out is that a lot of the supply chain stepped in to kind of manage the inventory and the sales proceeds and the invoicing legs. And there was a lot of what I would call, what most people don't give credit for is a lot of empathy is built in the system of normal trade, which, we get to realize only later. Whether it's a distributor looking out for retailers or whether it is the OEM looking out for his distributors, I think there's a lot of empathy that's built in. And if you really understand that, and if you can kind of use that in your supply chain practice, I think you end up not having to kind of, become the bad guy chasing around everybody for their, monies back. So I think that was the second point. I think third, which now RBI has done, Anup referred to it, this whole penal interest thing, I think really was the lack of empathy, if I were to kind of call it. And I think it is unfortunate that regulations have had to come in to kind of streamline that. But we did see that a lot of stress that was there was because, a typical micro business has taken loan from multiple sources. You are not the only source, and it's very difficult to figure out where all is he taken money from, because a lot of it is also could be informal. It was the penal and the collections process that really killed him, rather than, if someone had, kind of allowed them to kind of get back to that business. So I think one of the interesting things for us is to really try and understand what is the excess credit somebody is already having in the good times. And that excess credit, which is really bad in good times, actually turns out to be a little bit of a boon during bad times. And then also to make sure that this excess credit is being given by associations that really are not cruel in terms of their, penal interests or in their collection methods. I think Pallavi referred to very initially about informal methods. I mean, world over, I think chit funds, circles, whatever you call it, have been exceptional sources of informal funding. They have been far cheaper than most funding. We talk here in credit about frictionless credit and all that. They are an original example of saving and lending association. I think a lot of those actually came into fore during COVID, which was again a very interesting thing for us to kind of research into. So I think, a lot of it actually is not innovation from our side. It's a lot of uncovering already the good practices in the country and then figuring out how we can kind of pattern it. I think we are not actually building anything new. We are only kind of, I think, putting into digital stuff, what is already there and really good. But I think this was some of the learnings of the COVID side. And I think what I don't think, hopefully it will never happen, but it is, I think, probably the best stress testing that every model of every kind, whether in credit or payments or anything, even non-finance, logistics, I think had to go through. So I think, one of the very interesting things we have noticed is that most companies as a strategy are now becoming inefficient in inventory. People earlier were trying to exactly stock as much as needed. Now everybody is kind of being a little inefficient, and that's also causing a lot of inflation in terms of the overall financing required. A lot of times when we talk about our growth numbers, two places we can't take credit for is one of the inflation itself. And the second is the fact that a lot of the buying practices of corporate have also brought in a little bit of inefficiency very tactically to ensure that they don't get caught in that circuit. So I think those are the two other factors that have happened due to COVID, which I think is very interesting.
Right. So, I mean, interesting point that, you're talking about forbearance, right? How within the entire supply chain system, we had built in this empathy and, it's not just the regulators who were coming with forbearance, but also, the entire chain sort of understood that we are in this together and we need to sort of solve it. I think, guys, we are really running short of time. So I just would like to take a pause and maybe look at the question queue. So we have a couple of questions. The first one was, I apologize, I don't know who has asked this question, but the question is, there's been a recent ban on various apps, especially Chinese apps, and how does this affect the fintech industry? I would also just add, how does this also affect your fundraising prospects in the future? Yeah, any of you, please feel to jump in.
Sure, maybe if I can take it, Epan. Hello.
Yeah, please do. Yeah.
So I think there are two things that has clearly happened, Epan. One is the regulator for the longest time has been warning you can call it the fintech companies, or for that matter, even the payment companies, the digital lending applications, to be very, very cautious when it comes to dealing with the end consumer. Here we are not talking about a B2B or B2, whether it's SME lending or consumer lending, whatever. I think fundamentally what regulator has been talking about is to ensure that you're not charging these customers some ridiculously high interest rate, and the customer is defaulting. You're further penalizing him with additional penal charges on top of that, leading to what we have seen in the past about 10 years ago in the microfinance industry, where, God forbid, people start committing suicide because of stress and stuff like that. Right? Unfortunately, in the last 2 to 3 years, a lot of Chinese money through, we can there are various theories behind it, and we can go about it in detail at some other point in time. But there have been a lot of theories about people coming up with this innovative ways in which they were funding these end consumers, small ticket size loans, charging them some ridiculously high rate of interest, and then kind of using all kind of a mechanism to recover the money from these consumers. And about 3 months back, RBI came up with this very interesting thing, which was in a simple way. What they said is, are you a party or you're a broker? This is a very famous thing in the Hindi movie, Party Ho Ki Broker, right? And they made it very, very clear that if you are a broker, you need to behave in a particular manner. You can't have access to data. You can't take digital, just because you're a digital lending company, you cannot underwrite these customers. You can't provide these stupid FLDGs to banks and say, we will do everything on behalf of the banks, go out and collect the money, use various tactics to recover the money, and so on and so forth. If you're a regulated entity, these are things that you are supposed to do, and you cannot let your obligation get transferred to a digital lending application just because of the fact that they are sourcing customers for you and giving you FLDG. You cannot kind of transfer your responsibility from your own organization to a third party. I think all of this is great for the industry. I'm not saying it because we are a regulated entity. I genuinely believe that over the last 2 to 3 years, a lot of excesses have got created in the market. The same customers are getting over leveraged. At some point in time, the entire industry will undergo a stress, right? So it's better that we all are disciplined. And I don't think so it has anything got to do with fintech and non-fintech. I think overall as an ecosystem, because eventually when if I'm a digital lending application without an NBFC license, and I'm going to a bank and fund using the bank's balance sheet to fund to the same set of customer, the responsibility lies on the banks as well to ensure that just because they are taking FLDG from organizations like us, it does not absolve them from their responsibilities, right? So I think the whole ecosystem overall is something what RBI is questioning, that are you following the right practices to take care of the customer, and at the same time who's supposed to have the data of the customer, what is the mechanism around data security, and so on and so forth. I think it's all great for the ecosystem. In the long term, we will all benefit from this regulations being laid down by the RBI.
Right. It's definitely something that would help in the long run, Anup. You made this interesting point of regulated entities. So, I mean, there are a lot of fintechs out there who are not regulated entities, who are, what they call it LSPs, right? So, yeah, perhaps Ram, you can chip in here. Pallavi, feel free to join in as well. How do you guys see these LSPs? How do you see them evolving, given RBI's view on the buck stopping with regulated entities?
Look, I think honestly speaking, whether you're regulated or not, if you are in the financial world, it is better to kind of think you're regulated. I don't think there's a choice there. I mean, while a lot of angst has been poured over the fact that RBI has come up with all these regulations and circulars, the fact of the matter is that they're just restating what is already given. FLDG was never allowed. And so, I mean, there was no concept of that possible. So I think if you really look at it, it's a lot of restatement of the existing one. So I would think that if you are a fintech, you better read the circulars. Even though you may think you're not regulated, because you are going to get affected by it. So I think that's the first, I would just say is an important thing for us all to follow. The second, I think, is that, unfortunately, I think as an industry, we are funded, venture funded. And I think there's a lot of pressure on all of us to kind of grow insanely. And if you are in the financial lending world, you have to be exceptionally careful that you don't let that pressure come on to you in terms of lending practices. So while the Chinese applications are on the other side, but I would say even on the normal lending side, I think one of the big worries, at least I have been having, and again, just I think because of number of years there, like this BNPL, frictionless credit, I think are really worrying, because they end up kind of making credit, a very easy on the tap kind of an process. Credit is an obligation. So you have to be very careful about how you market it and sell it. This is, the credit can be as addictive as smoking or drinking. So you need to be kind of very careful about what you're peddling here. And I think that becomes very, very important also for even if you are, whether you're regulated or not regulated, that you're not mis-selling, you're not kind of selling without telling the obligations of that. So I think those are two things that all of us should have learned. If we didn't learn, I think the regulator is telling us you better learn. Having said that, I think it's going to be very difficult to actually make it work unless all the regulated entities who are partnering with these fintechs really kind of, I think act responsibly. I think it's also a fact that a lot of the regulated entities have also been kind of loose and fast on their rules. I think they will also have to kind of be very, very clear about how they behave. So I think it's going to take, one of the things that we all learn, right, when we are kids, that don't go to this locality, it is dangerous. Now, there are establishments within the locality which are actually very, very respectable and good. But, we are just told this entire locality should be avoided. I think the question really we have to answer is that we don't become like one of those localities. The entire fintech world or this lending world, I think we have to be all careful that we don't give ourselves that name. And I think to that extent, all of us who have been in this industry are regulated, not regulated, will have to treat it as a responsibility. I don't think there's any way around it. I don't think you should really think about whether you're regulated or not. I just think you should believe that you are in the business of transporting money, whether it's your own or whether it's somebody else's, and you take it very seriously.
If I can add to this, I think the guidelines are making it a lot more clearer for LSPs to operate in a certain way and REs to operate in a certain way. I think a lot more clarity has come in the last six to 8 months, where there is a structure where banks know what they need to do, LSPs know what they need to do. RE to RE partnerships are becoming more clear as to how banks and fintechs can operate together. And I completely echo what Ram said. That we have been working with you guys and EPIN and also with other partners as an LSP, and completely built everything on the back of the the lending partners, and I think it's only gotten better now with clarity emerging as to what are the roles and responsibilities of each of these partners. So I think the compliances become an equal responsibility for both the LSPs, the REs. It's not, there is no sort of a shortcut here that anyone can take.
Right. Thank you, Pallavi. It's clarity from the regulator is always welcome, and I think probably in the long run we all try to build our business models accordingly, and figure out a way to move things along. I've got one shameless plugin from my side. On the IMC bit. How do you guys think, forums like IMC, which represent, a lot of small businesses, medium as well as large businesses, how can we help, fintech such as yourselves, improve, let's say, your accessibility to potential clients?
Yeah, I think I'll take that first. I'm always looking for clients, as I'm sure Anup and Pallavi also. But I think, look, I mean, at the end of the day, I think there are 3 parts to it. I think one is obviously you guys have a lot more connects into the industry from a variety of angles. We obviously approach it from a monoculture of credit, or a monoprism of credit. I think we obviously would love to kind of be connected to bodies such as yours, which are talking to small business on a variety of fronts. It is not just credit; it is also a lot to do with their various regulations, the various enabling factors. So I think you all carry a lot more weight with those enterprises than we do. So I think first is to just let them know that there is something like supply chain trade credits. There is possibilities of kind of accessing it, trades, the international trade finance exchange or the normal trade credit. The second, I think, more important thing is the educating on credit, especially the smaller enterprises. I think that is a definite task that all of us will have to get into, especially organizations like IMC and government and everybody else, because I think that's a bigger challenge. What worries me really in this, and I'm no economist, is that the consumption pattern is still kind of befuddling me. We are seeing a huge take up. I'm not still clear how it is. My worry is that credit is kind of, superimposing the reason for why people are consuming so much. But I would say that, it's probably time that we don't repeat the earlier mistakes when credit became very easy and available, and then there were a lot of excesses. So a lot of, I think, help in educating people about in excess credit, I think, would really help. Secondly, and third, of course, be a shameless plug to all of us. Get us on forums, get us to talk about our offerings, and give us some ways of connecting directly. It reduces our marketing cost, and therefore will reduce the cost of lending, I guess, to the borrowers.
Right. Thanks, Ram. I think there is a bit of give and take over here, which is you guys can definitely help enlighten the wider audience at IMC on the benefits of being financially prudent and accessing this sort of fintech lending partnerships that they can take, and we can help you reduce your sales and marketing costs. So Pallavi, Ram, Anup, I'd like to just take this opportunity for thanking all of you joining this evening. It's certainly been a very insightful conversation, and it's a space that I'm personally very, very excited about. As a group, we love partnering with very, very cutting edge companies such as yourselves, And I wish all of you the very best for your journey ahead. And it's certainly a great nation building that all of you guys are doing by helping these small and medium businesses meet their financing needs. So thank you very much. Anita, is there anything else that we need to cover?
Yeah, so as we come to the end of this very enlightening session, may I request Ms. Shloka Nath, Chairperson, IMC Young Leaders Forum and Acting CEO, India Climate Collaborative, ICC, to conclude this session by presenting the vote of thanks. Over to you, Ms. Nath.
Thank you so much. And that was an amazing session. Epan, I think you sort of summarized it brilliantly when you spoke to sort of the nation building aspect of this work. It's not only been, I think, an incredibly informative and insightful session, it was actually really inspiring, and there have been so many take-home messages. I really love conversations like these because, as I said, they're so eye-opening. And I think the possibility of fintech today is one that I think all our speakers have really spoken to. So I really want to express my gratitude and appreciation for each of them. And of course, for Epan, who's organized this brilliant event. Epan is the ED of the Masood Group, and he's a member, of course, of the Young Leaders Forum at the IMC. Thank you to Anoop, to Pallavi, and to Ram for your time today, for your insights. I think it's been such a rich conversation around fintech. I think we're all going to sort of have a lot of takeaways that we'll be thinking about quite deeply. And so on behalf of the IMC Young Leaders Forum, as well as my co-chair Nirbhay Kanoria, I really want to express our gratitude, our appreciation to our speakers. I think, the challenges were outlined, but also, as I said, the opportunities around fintech. And I think, it's something that hopefully we can all employ in terms of the way that we're thinking about innovation in this space going forward. I also want to thank our audience. Thank you for taking time out of your busy schedules for being here with us today. I hope you enjoyed it. The fact that you're here and your presence is always a source of encouragement to us at the IMC. And of course, I want to, thank the rest of the YLF committee at the IMC, and of course, the IMC team for all their support. None of these events would be possible without the incredible, effort that goes into making these events happen from the IMC team. So thank you. Thank you, everyone, for contributing to the success of this event. I hope you all have a wonderful rest of the day. And thank you. We'll see you at the next IMC YLF event.
Hey, thank you, Epan. Thank you, everybody.
Thank you very much.
And thanks.
Everyone.
Yeah, thank you.
Thank you. Anita, close.
Yeah.